This is the agenda for today. We will briefly talk about who we are and what is the access to capital options are, advantage and disadvantage of equity financing and debt financing, how to create a financial strategy, what is debt financing option, it is loan. And we will talk about 5Cs, DSCR, and we will covering some case study. And later on, we will go to a Q&A as well. So what are your options when we talk about access to capital? Usually those are the main three category and who it is. They are self-funding, investor, and loan. Before you consider these three options, we highly recommend that you creating a financial strategy for them because you must sit down and thinking through if this business is feasible for you. First of all, please defining your goal. Again, counselor like us, we will sit down with you to lay out a business plan together. We would like to set a goal. And later on, the second step is to assess your current financial situation and set up an emergency funding. Because if you do not have a budget in mind, it's difficult for us to help because you must know your number. You must know your startup cost calculations, forecast, anticipating sales, cost of goods sold, expenses, and more. And also, if you're considering for a loan, you must plan for that repayment schedule because you do not want to default on a loan. And again, when we're building for a financial forecast, don't forget to include inflations in your forecast. And when we sit down together to build a forecast, we will help you to build the projections together. Here is a simple calculations of a restaurant business that how many days that you are operating. For example, if a restaurant only open Tuesday to Sunday, they have 26 business day. And well, let's put an example of operating of 8 hours per day, 20 clients per day, and average client spend willing to spend $15. That come up to a rough calculation of sales is about 62,000 per month. And let's move on to a next page. And Irene can share more about self-funding. Thank you, Irene.
Okay, now let's dive into one of the most common ways to fund a business, which is self-funding. Before we get into detail, let me quickly explain what self-funding is. It is also known as bootstrapping. Is when you use your own resources to finance your business instead of relying on outside investor or loans. You're pulling from your own savings, assets, or borrowing from close connection to get your business off the ground. Today, we'll go over a few key self-funding options: personal saving, borrowing from a retirement account, home equity line of credit, and of course, friend and family. First up is personal saving. This is often the go-to for many entrepreneurs because it's straightforward. You're using your own money that you've set aside. The biggest advantage here is that you don't owe anyone anything. There's no interest to pay, no repayment schedule. But the downside is that you're putting your own financial security on the line. So it's important to make sure you're comfortable with the amount you're investing and that it doesn't drain your emergency fund. And next, let's talk about borrowing from retirement account, like 401k. This can be a quickly a quick way to access funds. And the interest you pay actually goes back into your own retirement account. However, this option comes with risk. If you're unable to repay the loan, it could be considered a withdrawal, and you might face taxes and penalties. Another option is home equity line of credit, or HELOC. This allows you to borrow against the equity you've built in your home. The interest rates are often lower than other type of loans, which is big plus. But your home is on the line here. If you can make the payment, you risk foreclosure. So while this can be the great option, it's important to be confident in your business plan and your ability to repay the loan. Lastly, let's talk about funding from friends and family. This can be a fantastic way to raise money because these are people who believe in you and your vision. However, it's important to treat it just like any other business transaction. Have clear terms, put everything in writing, and be transparent about this risk. The last thing what you want is a strained relationship over money. All right. Now, that we've covered self-funding. Let's move on to another popular way to raise capital for your business. Equity funding. So what is equity funding? In simple terms, this is when you raise money by selling a portion of your business to investors. Instead of taking a debt, you're giving away a piece of your ownership in exchange for capital. It's like having a partner who brings in cash to help you grow, but they also share in the profit and risk. One common way small business use equity financing is through angel investors. I think you've heard this term, angel investors. These are typically individuals who provide capital for startup in exchange for ownership equity or convertible debt. They're often entrepreneurs themselves and can offer not just money, but also valuable advice and connections. Imagine you've got a great business idea, but you need $50,000 to get started. An angel investor might provide that cash in exchange for, say, 10% of your company. You get the fund you need, and they become a part owner in your business. Another route is venture capital, which is usually for businesses that are a bit further along and have high growth potential. Venture capital is invest large sum of money in exchange for equity and often take an active role in guiding the company. For example, let's say your tech startup is doing well and you need 1 million to scale up. A venture capital firm might offer that in exchange for a significant stake in your businesses, like 20 to 30%. They're betting on your success, but they also expect a big return if you hit big. Then there's equity crowdfunding, a newer and more accessible option. This is where you raise small amount of money from large number of people, usually through online platform. Each person who invests become a part owner of your business. Let's say you need 100,000 to launch a new product. You could set up a campaign on crowdfunding site, offer equity in your company, and get hundreds or even thousands of small investors to chip in. Okay, so another option for financing is we call it debt financing. It's like simply borrowing money. Debt financing is a way for a business to raise money by borrowing money from lender or promising to pay it back plus interest over a set period of time. Debt financing is popular way for business to get the cash they need to grow without giving up ownership or decision right. Some advantages of debt financing included um, you don't have to give up your ownership. And there are tax deductions. Also, low interest rate are available, like SBA loan. You will establish and build business credit that can fuel the growth your business. Debt financing can save small business big money. Bigger businesses can benefit from debt refinancing. Also, there is downside too. You must repay the lender. Qualifying can be difficult sometimes, especially startup or entrepreneurs. Is sometimes it's hard to finance, um, but also high rate. Unfortunately, predatory lenders exist, and then technique they use rope in unsuspecting small businesses owner and getting more difficult. It impacts your credit rate too. If you don't repay, it will impact big. You may need collateral. Okay. So Elaine's gonna explain the more options about the loans. Elaine?
Thank you, Irene. So there are a couple options for loan. Like Irene mentioned, SBA loan is very popular because the advantage is that it is a market rate and usually the term is longer. And also there's some disadvantage too, that collateral often are required. And also SBA, another disadvantage of SBA is sometimes it is a longer repayment terms. Other options is conventional loan. Usually they are more for a well-established business and the rate is very competitive. This is this advantage because for conventional lenders, they are looking for a lower risk borrower. And the disadvantage of conventional loan is like SBA, collateral is often required and it is a longer approval process because again, they are looking for a lower risk business and usually the repayment ability is really high. So who will look for online lenders? Usually people that who are looking for a quick approval and funding because it is one of the online lender advantage. However, if you want your money fast, this is also a trade-off. Disadvantage is usually it will be a high interest rate and shorter repayment term. And I will describe CDFI is more in the middle. We're in the middle between SBA and conventional loan. CDFI like us, we are willing to take risk. For example, with us, we're willing to look at the case if the borrower credit score is 600 and above. Compared to conventional lenders, they are looking for a credit score at least 700 plus or even 800, depending on the economy. Advantage with us or CDFI is our terms is pretty flexible, and we are focusing on serving underserved community. But it's a trade-off, a disadvantage working with a CDFI. Usually our loan amount is a little bit smaller compared to conventional lenders. Sometimes they can do over $1 million. And also it's a potential higher interest rate than SBA. Irene, did I miss anything?
Well, as a CDFI, usually conventional loan doesn't approve the entrepreneurs and for a startup, especially pre-startup, they don't even look at it. But we, I just got approval for pre-startup. We take the pre-startup business as well. So that's a big plus for startup business.
Thank you, Irene. If there is no more additional information, maybe we can move on to a other slides. And why are lenders asking these questions? I thought that I submit the case to the counselor and it's already giving to the underwriter for review. Tell me why that I already submit everything and the lender still calling me for this whole bunch of questions, asking me what is the loan purpose, asking me why I need this, asking me my credit score. Irene, would you like to tell us more about why?
Sure. So after underwriter review your case, the last stage of your loan process, you often get a call from lenders. They want to confirm your identity and little more about your business. Lender wants to understand the risk after all. That's why they want to ask some question about you and your business.
Thank you, Irene. Which is credit, cash flow, capital infusions, collateral, and character. All right, let's move on to the next page. Yes, it is 5 C's. 5 C's is credit, cash flow, capital injection, collateral, and character. And why lender is asking those information? Again, like Irene mentioned earlier, it is all about risk assessment because credit, we would like to see your credit score to see if you are a responsible borrower because each applicant will personally guarantee the loan, meaning that if you default on loan, your credit score will be impacted. And cash flow, why it is important? Because it is showing the character of how the business owner managed the cash, the spending habit. And later on the slides, we will explain what kind of supporting document for this category. And capital infusion, it is like we mentioned earlier, it could be from self-funding, investor, family and friends, your business partner, or through loan or crowdfunding. And collateral, it is very important because it is offset the weakness of other C's. And character is about who you are. Do you have any experience of running it? And if you are your credit history to see if you are your repetition of your credit and your money spending. And Irene, do I miss anything?
No, you're perfect.
All right. So it is 5 C's, and this is the related supporting documents. Usually during the initial assessment process, we always ask for a easy screenshot that will be capture your FICO score is. And when we are packaging the loan and submitting to the underwriter, we will do a hard pull for it. And how a business loan counselor and the underwriter assess your cash flow usually is by this supporting document, such as year-to-date financial statement, business and personal tax return, and also the bank statement and year-to-date financial statement or profit and loss. And how to prove your capital injection? Cash on hand, maybe the receipt from a lease deposit for a commercial space, down payment for a commercial vehicle or property. Collateral could be spelled out on the balance sheet, and also we'll look at any business and personal vehicle or commercial real estate. And character. Besides the credit report, we will also ask the borrower the industry background as well. And let's move on to another page. And what is DSCR? DSCR stands for Debt Service Coverage Ratio. And Irene, would you like to tell us more about DSCR?
Yes. Moving forward, let's discuss an essential aspect that lender consider when you're applying for a business loan. Your ability to repay the loan. Lender wants to ensure that your business generate enough income to cover the loan payment comfortably. One of the key metrics they use to assess this is debt service coverage ratio, or DSCR. DSCR, simply put, it's a measure of your business cash flow versus its debt obligations. A higher DSCR indicate that your business has more than enough income to cover its debt, which is green light for lenders. Calculating DSCR might sound complicated, but it's pretty straightforward. So DSCR is net operating income total debt service DSCR equal total debt service, not net operating income. So Elaine's gonna explain more detail easily.
Thank you, Irene. We will also cover a little bit about DSCR during our case study as well. So let's say you have a business with the annual revenue for about $200,000 and your operating expenses is roughly about $120,000. So the net operating income calculating like this. It is 200,000 minus 120,000 equal to 80,000. And let's say you have a existing loan that total repayment is 30,000 annually, and you are considering taking a new loan that add additional 10K for your annual repayment. The total debt schedule calculating is 30,000 plus 10K, total of 40K. And how we do that calculation? So as you see here, we put the net operating income here and divided by 40K equal to 2. And Irene, can you tell us why? 2.0 is the magic number.
Yeah. Okay, yeah, 2.0. We call it magic number. That your business generate twice the income needs to cover its debt obligations. Generally, lender look for a DSCR of at least 1.2. A DSCR below 1 means your business doesn't generate enough income to cover its debt, which is you might not able to apply the loan because it's red flag for lenders. Okay, now we are doing the case study with Elaine. Elaine?
Thank you, Irene. So this is a case study about a food truck. So Maggie and Connie, they are friends and they are operating a food truck, MNC. And the background is they are transitioning from a food truck to a brick and mortar. they are asking a business loan of 50,000, and the loan purpose is for paying rent, payroll, and purchasing new equipment. Maggie credit score is 750 and Connie is 630. They're providing a 23 business tax return with the annual revenue of 16. Oh, I'm so sorry, a typo. Actually, the net income for them is 168,000 with the net average per month is $1,400. And because they are moving into a brick and mortar, they already signed the lease and they put down 7,000 for the lease deposit. And since they're operating a food truck, so they have a pickup truck in the front and a food trailer in the back. And both pickup truck and the food trailer is already paid off. And they start the business. The first sales was made in spring 2022. And here is the activity, and I would like you all to respond either through Q&A or chat box. Do you think the business could afford a monthly loan repayment of $1,100? Based on what you learned in the previous slides to calculating the DSCR, do you think they're able to repay the loan with the average monthly of $1,400? You can respond by using the chat box or the Q&A, and we will check your answer. Let's give like 30 seconds maybe, or 1 minute, 2 minutes. Okay. So it is 5:05 and we will chat back with you in few minutes. Again, look at the net income, net operating income for them every month. It is $1,400. And the repayment for them is $1,100. Do you think they're able to afford the loan? I see quite a lot of responses coming in. Some people say yes, some people say no. And now look at the 5 C's and C. Yes, we believe based on the simple calculation, we believing that they are able to afford the $1,100 repayment. Again, let's look at the credit score. What is the reason why that we give them a 5? So we add Maggie and Connie credit score together and divided by 2, it is about 650. So we score a 5. And cash flow, again, available cash flow every month is $1,400. And require, meaning that the monthly repayment for loan is $1,100. Then we divided 1,400 and 1,100 give us a 1.27. Again, like I mentioned, the magic number is above 1.25 or closer to 2. So we give them a 3. Initial capital investment or the cash injection, they put $7,000 as a lease deposit and they are requesting a loan of 50K. It is about 14%. It's up to 20, so we give them a 4. For collateral, again, remember that the truck and the food trailer is already paid off, and according to the balance sheet that they provide, the value combined is 11,000. And they're asking for 50K, and this is the calculation. It's roughly 22%. And they have been operating since spring 2022. And that adds up to 20 points, meaning that it is a doable case because the minimum score for us to submit to the underwriter is 19. So we highly believing that it is a good case, right, Irene? So we can move on to another case study.
Yeah, this is highly recommended and it seems strong case. And we can proceed the loan and then hopefully they will make a 50K. Let's move on to different case.
Thank you, Irene. So case 2, we have Alex. Alex is also in food and beverages business, and he is operating a restaurant called Alex Kitchen. He is also asking for a loan of 50K, and the purpose is paying rent, payroll, and new equipment. Same as the food truck. And this is the profile of Alex. Credit score is 660, and he providing the tax return for 23. It is 11,000. It is average 917 per month. Capital injection, he can only afford $3,000 to this loan. Collateral is all the existing business asset, the equipment. And same as the food truck, he start the business in spring 2022. And again, let's take a few minutes and see, do you believe Alex is able to afford the monthly repayment of $1,100? Let's have a few minutes for you all to look at the case. Again, today we put you in the role of an underwriter, right? So we will do a quick activity or exercise. Do you think Alex able to afford the repayment? I do see some responses coming in. Some people say no, no, his cash flow is less than the monthly repayment. Yes, it's a no, definitely not. All righty. Thank you all for responding, and let's look at the 5 C's. The credit score is 660, so it's definitely above 650, so we give him a 5. The cash flow, yes, is a little bit low. It is 1.19. You guys are correct. Available cash flow is 917, but require for the repayment is over $1,000. And you see the calculation here, 110 and 917. Capital ingestion, and he only able to contribute $3,000. And it is roughly about 6%. So we give them a 3. For collateral, he can only willing to pledge the existing equipment. Same as the food truck, he start in spring 2022. So it's still a 4. So we are missing 2 points here. So let me ask you guys, if you are the loan counselor and you really want this case to move forward, how would you suggest Alex to make this case stronger? I may have about 1 minute, 2 minutes for you all to respond, and put yourself into Alex or put yourself into a loan counselor. You really want to push this loan further, and you really want him to get the 50K. What would you suggest to Alex? It's only missing 2 points. All righty, let's look at some answer. Offer more collateral. Get a personal loan to inject more into his capital investment. Larger injection. Increase collateral or more. Oh wow, correct. Yes. All the incoming answer, they are on point. Correct. We highly recommend Alex to increase the injection or increase the collateral. Increase injection, even though Alex willing to put like 2,000, 3,000 or a little bit more, it could bump up to 3 to a 4 or even 5. And of course, besides the existing business equipment, if Alex has a personal vehicle or a commercial vehicle that is already paid off and he willing to pledge, that could bump up the score as well. Thank you all for responding, and we can move on to loan application and decision process. Again, it is more for educational and informational purposes. Each lender processing time and application process is slightly different, but usually they go into this route. Initial meeting, loan counselor meet with the client into the loan packaging stage. Usually depends, is roughly between 2 weeks to 1 month, depending on how fast or how complete the package will be. But sometimes, the borrower will still pending document from the accountant, CPA. So we highly recommend file your tax return or have a active bookkeeping system ready. And after we meet, we package the loan and we will submit to the underwriter for review. And usually the underwriting time, depending on the workload as well for the underwriter, and roughly between 2 weeks to 1 month. And if the case is doable, then we will move forward. The underwriter and the counselor will move forward for consideration stage. If not, it could be the reason is more information needed, clarification, and the case will return back to the counselor for revision. And once we push the case forward to the consideration, usually take about 14 business days or more. And sometimes there are two outcomes, approve or denial. If approved, the case will move forward to closing and funding. And if not, then usually the case will return back to the counselor desk for further clarification and hopefully submit it again for reconsideration. And if the case is good to go, the case will move forward to closing. And during the closing, the final interest rate, terms, and condition will be in place. And the borrower will sign off the document and ready to cut the check. Usually the turnaround time is 14 business days or more. So now we get to the fun part. Frequent asked questions. Those are the questions that usually people call us. Am I still liable for the loan? What if my business is not doing well and I want to close it? The answer is yes. Each applicant is liable for the loan and you are personally guaranteed for it. That's why when we do the 5C underwriting, we are also doing the risk assessment as well. Do I qualify for a loan? I filed a loss in 22 and 23. I would say most likely it's a no. Again, when we look on the cash on hand and the repayment ability, we will look at that carefully. And Irene, did I miss
Well,
anything?
usually when the loan counselors collect the finance, typically 2 years of bank state, 2 years of tax return, personal and business, and 3 to 6 months of bank statement. Why we look at this financial? Because we want to know the global cash flow is supporting the repayable ability. So if you you have lost in 2022 and 2023, its chance to apply for a loan is very low. And also, I highly recommend you usually, some of the business don't report the cash income, but I highly recommend you to report maybe like more than 70% or at least 80% of cash income, because I saw a couple of clients who had cash income but didn't report the tax return, and then they have a very little of a revenue or even loss. And it's very hard to prove, oh, I have a cash, but we can't prove. So I highly recommend you to report your cash income.
Thank you, Irene. And another questions we always heard about is what kind of financial document do I have to provide? I haven't filed my tax return. Like Irene mentioned earlier, business and personal tax return are crucial for lenders to do the risk assessment. And lenders review tax return and bank statement to see if the borrower and the business repayment ability. So they are very important documentation, and also the financial year-to-date financial as well. And do I have a chance to apply for loan? My business is still in pre-revenue stage. We got that questions a lot, and I would say it depends, because later on, Irene will share about a little case that she mentioned about a pre-revenue stage. But this is why 5 Cs is important, because it is more than just loan to help you get started. So Irene, would you tell us more about the case?
Yeah, I highly recommend you to check your 5C your own so you can see where you are. And maybe if you score yourself and then see, oh, I'm 19 or I'm 23, go for it. Just apply the loan. But if you see, oh, which part is weak, you can improve that part like a credit. If you're giving yourself like a 3 or 2, you can improve that part. And if you don't have collateral, you can really have a collateral overnight, right? So you can improve the other part, such as like more capital injection or other part. So we as a PACE, we take, like I mentioned earlier, most of traditional bank don't even consider to lend pre-startup or startup business. We call it startup is like establish the business up to 3 years, and but we take the loan cases for startup or pre-startup, but they don't have well-established the business account, but we review your personal account, personal tax, and personal bank statement. So if you have a pre-startup or startup business and you want to consider applying a loan, please feel free to contact us.
Thank you, Irene. And let's move on to another page about a summary. Yes, like we always mention throughout the webinar, to ensure a smoother process, we highly recommend business owner file the business and tax return timely and properly. We are approaching, I cannot believe we are in mid-September and we are approaching October really soon. So file your personal and tax return timely and maintain a good habit of financial record keeping. And when you about to sign a closing document, consider all the fee terms and interest rate. And again, it is a loan. You must repay. Payment on that must be made regardless of your business revenue, and you do not want to default or delinquent on your SBA loan, because defaulting on an SBA loan or loan in general not only impact your personal credit, but also will make you disqualified for future federal loan or grant. And let me give you an example. I have a client that in the past delinquent on the 2022 COVID-19 SBA loan. And When she applying for a new loan, she got disqualified because again, she delinquent on the past SBA loan. So please, if you need to work on a payment plan with the lender, reach out to them and see how they can help. A bonus for this session today about crowdfunding. Besides self-funding or loan or investor, you may want to consider crowdfunding. Crowdfunding is raising funds from your supporter, contributor, and in return for the initial contribution, your supporter will receive some sort of reward, maybe your new innovation product, service, or items, or both.